It's easy to think a financial forecast is something you just produce for your bank or accountant when asked. It isn't. And that misunderstanding is exactly how cash flow problems can become a crisis. A financial forecast is a rolling monthly view of money coming in and money going out, covering a period of time, perhaps 12 months. Well, that's it. It isn't a prediction you're expected to get exactly right. It's a working model you update as reality changes. Think of it less like a crystal ball and more like a dashboard. Actual figures go in every month, and projections shift forward, and you always have a perhaps 12-month view ahead. The goal isn't accuracy for its own sake, it's visibility. Without that view, a cash shortfall only becomes visible when there's no room left to act. But with it, the same shortfall can appear weeks or months in advance. And that gap is where your decisions need to live. Here's where a forecast earns its value. Once you have a base case, run a scenario alongside it, a conservative one. South Tyneside Council business guidance suggests stress testing with 20% lower sales or a delayed start to new revenue. Ask yourself, what does cash look like in month 4, month 7, month 10? Say you run a service business with a strong pipeline but slow payment terms. Your base case looks fine. Your conservative case, one with large clients paying 60 days late, shows a shortfall in month 6. That's not a crisis yet, but it is a decision. You might accelerate invoice chasing, or open a borrowing conversation before you need the money, or defer a planned hire. None of those options exist if you only see the shortfall when it's already arrived. The forecast doesn't prevent the problem, it gives you runway and time to act. A forecast on its own is just a spreadsheet. What turns it into a decision tool is trigger points. Preset thresholds that force a specific action before a shortfall becomes a crisis. For example, cash dropping below 2 months of operating costs triggers a hiring freeze, or approaching 50% of your overdraft limit triggers a conversation with the bank. Revenue tracking 15% below forecast for 2 consecutive months might trigger a pricing or pipeline review. You can set these thresholds in advance when you're thinking clearly and not in the middle of a cash squeeze. This applies to finance directors and senior managers just as much as founders. The forecast gives you the numbers. The trigger points give you the protocol. And without them, you're relying on someone noticing a problem and deciding to act. With them, the decision of what to do is already made. The most common forecasting mistake isn't building a bad model, it's building a good one and leaving it by itself. A forecast updated once a year is not a forecast, it's a historical document. The value comes from rolling it forward every month, by dropping in last month's actuals and extending the horizon by 1 month and updating any assumptions that have shifted. Once that model exists, it takes 30 to 60 minutes. Without that rhythm, the early warning system goes dark. So the rule here is if your forecast doesn't have trigger points and isn't updated routinely, it frankly isn't doing what it's meant to do. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.